Welcome to Veranda CA. We'll continue with this session on this trust, charitable and religious trust. In the previous session, we had actually covered about what does this chapter attract, what are the contents of this chapter, and what exactly is the charitable purpose, the specification about this advancement of general public utility, and then we also spoke about what are all the incomes that will be covered in what circumstances. So, this is what we had covered. We also discussed about in detail about the eligible funds or institution that are covered under 1023C, clause 23C. So, now what we are going to do is we are going to just continue further to understand sections relating to what are called as income under section 12, and then we are going to understand what is the registration process of a particular trust and what is not allowed in section 13. So, this is what we are going to see in this particular session. Apart from this, we will understand political trust and electoral trust and certain sections where there are special tax regime for trust. So, that is what we are going to understand. The first one is section 12. So, section 12 it specifically talks about, we are going to understand here about the income from contributions. So, the first concept is voluntary contributions. What is voluntary? Basically on their own interest. So, whatever is received by the trust, it could be created for the wholly for charitable or religious purposes. So, it must be received by a trust which is actually created wholly for the charitable and religious purposes, not being made to form part of the corpus fund. So, the voluntary contributions will not include funds which are actually contributed to be part of the corpus fund with the special directions to be part of the corpus fund. So, that is not an income, that is not a contribution. That is basically covered under this taxable income level for this income tax purposes. So, it is, as we discussed in the earlier session, it is a capital receipt, it is a capital receipt. Now, when you actually see about this, the value of services, whatever we are talking about is certain things. If you want me to compare this section, it is something like your 40A2B. So, where you say that the related party transactions, if it is between these persons, it has to be considered. Similarly, in transfer pricing also, we spoke about this related party transactions. So, certain value of services is not considered as a service, it is not considered as a contribution or income. So, since it is between related party, such services will be added to your voluntary contributions to be considered as an income. So, what are those? It is basically any service made available, when I say services, we were speaking about the 1023C, which are primarily for medical, health and education institutions, so hospitals and education institutions. So, services there is made available to any charitable or religious trust which is running hospital, medical institution. So, such hospital or institution is providing a service relating to the medical or education to whom? To author or founder, that is one who has created this, and then a person contributing in excess of 50,000 in a previous year, a member of a family if that author or founder is a HUF. So, if the author is belonging to an HUF, then the member of such HUF, any trustee, manager of trust or institution, that is any one part of this trust, any member part of this trust including the trustees, and any relative of these persons. So, these are all covered as this thing. So, whatever has been provided as free service or concessional service, the words covered here is free and concessional. So, these are the only two things that is covered. So, it is either free or concessional. So, out of these two, if there are any services provided to these persons, being a medical service or educational services from such hospital or from such education institution to these persons, that is author or founder, the person who is contributing in excess of 50,000, member of HUFs in case if the author is an HUF, part of that HUF, then any trustee, manager, trustee or any relatives of all these persons. So, such free or concessional services is also income, in the angle of section 12. So, now to claim this exemption under section 12, whatever exemption you are trying to claim under this section 12, what are the conditions that you need to follow? The first one is of course a registration. So, the first critical thing is it must be a registered trust. So, section 12A says to claim the benefit of 11 and 12, to claim the benefits of section 11 and 12, you must be a registered trust. Earlier the registration was happening under section 12AA. From this particular portion, that it will be from 12AB. So 12AB was the new process. So 12A says, 12A subsection 1 clause AC says that the registration has to happen through a process prescribed under rule 17A, and the relevant section is 12AB also. So this is the rule applicable. Now what is the change here? Why do you need a change in the registration process? When you say registration process, basically someone is going to say, see, this is my trust, these are the activities that I am carrying out. If I am eligible, I am going to be awarded the trust, I am going to be an eligible fund or trust or institution, right? So what is the need for the change? So the primary subject, what has actually undergone this changes, first thing is it is made online, and then they have given a unique registration number. So this URN stands for unique registration number. So this unique registration number is allotted to a trust. So it's not PAN that we are talking. What is allotted is a unique registration number, and the provision now allows for provisional registration. So this becomes very, very critical. Earlier, if you have to actually register as a trust, if you wanted to register yourself as a trust, you need to have a history, you need to have a background, you need to have supporting documents to say that you have been doing it for a period, so provide me registration. Now they say, see, in the beginning I'll give you this provisional registration before you even commence activity. Before you even commence the activity, I'll give you the registration. You take care of it. Then I'll tell you how to upgrade it or how to renew it to a formal registration process. So these are the prominent changes in the new registration process from what you have been studying earlier under section 12AA and what is now prescribed under process under section 12AB. So this process, when someone has to apply, how someone has to apply, is all provided in section 12A subsection 1 clause AC. The detailed process is available through rule 17A, which was notified subsequently. So this is what is about the registration process. And the second important thing that they are talking about is audit. So they say, unless it is audited, the accounts of that particular trust must be audited. So to see that whenever there is a maximum amount chargeable, which is not a maximum amount, that when you cross the basic exemption limit, it has to be audited to claim these exemptions. When you say the basic exemption limit, you are not talking about taxable income, because when you say taxable income, you will say that it is already exempt. It is already exempt, then my limit is less than the basic exemption limit, so audit is not required. So what the income tax says is, without giving effect to section 11 and 12. So without giving effect to section 11 and 12, income tax says, without giving that effect, you calculate the income. You calculate the income and understand, is it above the maximum allowed exemption limit. So that only then see that whether it is whether the accounts require audit or not. So that's the second thing. The third one, it's also a recent amendment. Probably when I say recent, it's like 4 years or something. So this amendment is nothing but to claim this exemption, under section 11 and 12, the trust must file the return of income in accordance with 139 subsection 4A. So 139 4A is the provision which talks about filing return of income for these trust, eligible fund institutions, all those things. So it says, before the due date of return of income, whatever is the required time for such filing, please proceed. So whatever has been specified as a due date under section 139(1) and in accordance with 139 4A, please file the return on time. Only then you can claim exemption under section 11 and 12. So to avail this benefit, of section 11 and section 12, section 11 talks about accumulation and application. We said either apply or accumulate, right? When we said 11, we said either apply or accumulate. So what is apply? At least 85% or 15% you need to accumulate. You can also accumulate that 85% for a period of 5 years. This is what we have been saying. We also discussed that in detail in the earlier session. Now what we are saying is, to claim this benefit of this section 11, or whatever we are saying that will be an income that is not taxable, that is your voluntary contributions will not be taxable. So such things whatever we are talking about is this section 11 and 12 benefit can be claimed only when the return of income is filed on time. So we saw three requirements, three conditions. What are the three conditions? The first one is registration is mandatory. So there has been a new registration process prescribed under section 12A subsection 1 clause AC, and there has been a rules prescribed under 17A also. So we saw what are the salient features, what has been upgraded in the recent changes to this registration process. The second important thing is audit. We said books of account must be audited if the income without considering section 11 and 12, if it crosses the basic exemption limit, then it must be audited. So that's the one thing we discussed. The third thing, return of income should be filed within the time specified under 139(1) in accordance with section 139 subsection 4A. So that's about it. Now coming to this registration process, we said it has completely been overhauled, right? So it is completely overhauled. So there is a complete revamp of the entire registration process. So this 12AA is now moved into 12AB. So there is a revamp of this entire thing. So we are going to understand about what category of registration we are talking about, what is the time limit for applying, what is the time limit for passing the order, and what are the powers in that process of application to order, that is whether the concerned authority, what can he do? Can he review it in detail or he should not review it in detail? We are also discussing about that. And finally, for what period will that be given? So when you are trying to understand this in a tabular format, columnar way, you will probably have a better understanding about what are we talking about. You will also compare between each section or each clause we are talking about. So we will start with the first thing. The first thing is about re-registration. What is re-registration? I am already registered under 12A, I am already registered under 12AA. So if I have been registered under some earlier sections, some earlier provisions which are already there before implementation of this 12AB, then I need to re-register. What is the timeline for re-registration? Similar to what we saw in 1023C. What did we see in 1023C? We said it has to be done within 3 months. Currently, since this provision is only applicable from 1st April 2021, the due date for current year alone is 31st March 2022. So all the existing trust which have already been registered under section 12A or 12AA must re-register themselves before 31st March 2022 in form 10A. So we saw that it is amended through a circular. In the earlier session we saw that circular. So now before 31st March 22 it must be re-registered. For this re-registration, can the principal commissioner or the commissioner call for the documents, go through and re-request? No, there is no process of that. So what they say is, see, at this point in time whatever we are saying is, you are already registered, so we are not doubting you. We completely trust you that you are only doing in charitable purpose. We know that whatever you are doing is only for advancement of general public utility. We know that you are following in compliance with all the educational thing, medical, whatever reason that your objective is. So with all this, the principal commissioner or the commissioner will go ahead without considering any additional documents or something. So what? The officer, the concerned authority does not or probably will not call for a document, will not incur it in detail. So it's something like automatic. I've got an application, I just go through that and I proceed with this. So the time limit for passing this order is 3 months. 3 months from what? We have been always telling this, the month when you say, it is from application month end, that is application month end. So the month in which application has been filed, from that month end you take 3 months. So probably I'll add this asterisk here. So wherever we are talking about months, it is from the application month end. So that's what we are calling here as the time limit. Okay. So now 3 months from the time in which this month end in which this application is actually filed. So that's how this 3 months calculated. And what is the time period? See, if you actually wanted to remember it better, we have already gone through in the earlier session about this 1023C. It is almost exactly same. How is this 5 years calculated, or how is this 3 years calculated, whatever period that we are saying, it remains the same. So probably you can remember this hand in hand. That is, if you go through this two, you will understand the similarity between both these provisions, that is approval under 1023C and approval for this 12A. So that's what we are going to, that's what we are seeing right now. So you can compare it and understand that it's almost same, or in fact it is exactly same. So 5 years from the earlier registration. So whatever registration was earlier given, they are going to give it for a 5-year period, 5 assessment year period. Now the second category is renewal. So you might renewal. So what do you mean by renewal? Your period is about to get over. You are already registered. Your period is about to get over. So in that case, it is 6 months prior to expiry. So whatever was the expiry period, before that you will have to do it within 6 months. So it's actually 6 months, not days. So it's not 180 days or something. It is 6 months. So it is before 6 months, and the form is 10AB. So they'll have to use this form 10AB and say, for this, since it is renewal, I am going to give a fresh registration approval. That is, as an authority, as a principal commissioner or commissioner, I am going to give a fresh approval of this. So when I say fresh approval, what happens? Automatically, when I talk about this renewal, I will have to incur. So I'll have to call for document. I'll have to discuss all these things, right? So whatever we are talking about, the powers of an assessing officer. So he can call for documents, he can incur any documents he wish, all these things, right? So such things is allowed. In the earlier thing for re-registration, we said it is not allowed. Here it is allowed, and time limit is 6 months. So this is also 3 months, this is also 3 months. That is, for application 3 months, for passing order 3 months. For application 6 months, for passing order 6 months. So that's the correlation between the application time and the order passing time. But in the passing order time, it is 6 months from the month end in which application was actually filed, right? So that's how it is actually calculated. So the common term which we said, which will be using it across the session, will be this month end in which the application was actually submitted. So that is 6 months, and 5 years from the assessment year immediately following the financial year. So if you wanted to actually tell me this IFE and thing, see, generally in income tax we have concepts like IFE, which is immediately following financial year, and you have EP, that is immediately preceding previous year. So this is what. So probably we can have indications for all these things to see how this works out. So this is about IFE, that is immediately following financial year. So the year in which the financial year in which the application is actually filed, from the assessment year after that is what the 5 year will start with. So 5 years from assessment year immediately following the financial year of that application, the year in which application was filed. So if application is filed in February 2022, the financial year immediately following financial year is what? 2022-23. So that assessment year is what we are talking about. So that assessment year will be 23-24. The assessment year 23-24 is what, from which it will be applicable. So that is 5 years from that. So that is for renewal. Now what about this final registration? What do you mean by final registration? We said there is this concept of provisional registration, which is a new feature in this new concept of registration under section 12A, subsection 1, clause AC, right? So in this new concept, we said there is this provisional registration. Moment you have registered under provisional registration, you will have to actually finally finally register it as a proper trust. So this time period is basically at least 6 months prior to the expiry period. So before that provision ends, you need to apply it, or within the commencement of its activity, whichever is earlier, that is V, right? For this also, if you wanted me just deviate from this trust and talk about it, V stands for whichever is earlier, well stands for whichever is lower, and then you have WEH, which is whichever is higher. So typically these are things that you can remember in short forms as an acronym or something, to see how well you can remember the subject as a whole. So this will help you in knowing things better, that is keeping things in your memory for a much longer time. Okay, so coming back to this, we are talking about this provisional registration where we are going to talk about this final registration concept. So, it is at least 6 months prior to the expiry or within commencement of its activity, whichever is earlier. So, for that also the form is 10AB. Whether the consent authority can inquire, call for documents, other thing, yes, he can call for. The time period for this also for passing the order is 6 months. So, for this also the time period for registration to be granted is 5 years from the assessment year immediately following the financial year in which the provisional registration was granted. So, earlier we said application, here it is provisional registration. So, that is the third category. So, we spoke about re-registration, we spoke about renewal. Now we are talking about final registration. And then you have the fourth one, which is revive inoperative registration. So, when you say revive inoperative registration, there is something which is not working. So, something which is not working. So, there was a trust which was completely operational. So, this trust whichever we are talking about is now inoperative. So, now we are filing an application to say, see, by mistake it was inoperative or for some reason it was inoperative. I wanted to revive, as a trust I wanted to revive, so I am filing an application. So, what is the time period in which an application should be made? At least 6 months prior to the commencement of assessment year for which registration is sought. So, at least 6 months prior to the commencement. So, in which year probably that seeking registration? 6 months before that. So, if you are actually seeking registration for previous year 22-23 or previous year let us say previous year 22-23, you will have to do it before on or before 30th September 2022, that is 2021. Only then that is 6 months, right. So, just to rephrase it, we are talking about previous year 22-23 is what you need registration 6 months before this date. So, it is 30th September 21. So, within that date, on or before that date, you need to file it, and yes, of course, the principal commissioner or the commissioner can call for inquiries and other things. The time limit is again 6 months. If it is 6 months for registration, it is also 6 months for passing an order. It is 5 years from application, from IFE, assessment year of IFE. It is 5 years from the application. So, that is that. And the last one is in probably one more thing before the going to the last case. It is modification. Whenever there is any modification required, so there is something in the trust which requires modification. So, for such modification, within a period of 30 days, from the date of said adoption or modification. So, moment you have decided to modify the trust clause or something, 30 days from the date in which, within 30 days from the date in which it is modified, you need to file an application. Here also you will go through it again, because of course there is a change in the trust clause and other thing. So, now the officer, the consent authority needs to know whether it is in order, whether the changes are in order, whether the changes are still capable of being referred as advancement of general public utility or relief for poor or yoga or whatever it is. So, will that still be classified under that category? And then you will proceed on to give an order within 6 months. 6 months from what? Here also you can add this asterisk. So, I am trying to draw an asterisk. So, this 6 months is basically from the time in which you have actually filed an application. From that month, then it is 6 months. Here also it is 5 years from AYFE of that particular application. The last one is about other cases. In other cases, they are giving you probably 3 set of information. So, the first is, what if the trust was formed before 1st June 2020, but an application was not made? And next one is, it was actually formed after 1st June 2020, but it was actually formed after 1st June 20. And the last one is, a trust is formed before 1st June 2020 and which has already made application before 1st June 2020, but it has not been registered till that date. So, these 3 cases. So, for these 3 cases, that is trust formed before 1st June 2020, but no application made, a trust institution formed on or after 1st June 2020. The third one is a trust or institution formed before 1st June 2020 and application was also filed before 1st June 2020. So, for these 3 cases, they are saying you make an application at least 1 month prior to the commencement of the previous year relevant to the assessment year from which the said registration is sought. So that's again for this also it is 10A. For here also there is no inquiry that we are talking about, and it has to be passed within 1 month, and the period is 3 years from that. So this is something like your provisional registration. So there is nothing to review or discuss. So then automatically when you apply, registration will be provided to you. You will be provided with a provisional registration within that 1 month, and it will be given for a period of 3 years. Within that 3-year period, you are expected to commence the activities of this whatever information whatever activity that we are talking about. So that's when the final registration comes into picture, which we discussed earlier. So these are the timelines of registering under section 12AB, which is discussed in section 12A subsection 1 AC, read with rule 17A. So that is what this registration is all about. We are moving to the last phase of this trust provision alone, that is typically between section 11 to 13. So we are going to understand what are the income that are not eligible for exemption. We discussed about what are the income that are eligible under section 11. Now we are going to talk about what are all the income that are not eligible for exemption. The first thing is if it is a private trust, if it's under a trust for private religious purposes, something like private trust. Similarly, particular religious community or caste. So if it is anything particular to a particular community or a caste or whatever, it is not allowed. So these are the two concepts which are basically not allowed. The third thing is, in case if the trust laws are in favor of, or it is or probably what it has transactions for the benefit of. So for the benefit of the list that we discussed in 1023 also, in section 11 also. So basically the author founder, the person contributing more than 50,000, if the author is the part of HUF, the other members of HUF, trustee, manager, relatives of aforesaid persons, and also concern in which such person has substantial interest. When you say substantial interest, what? It is more than 20%. So that's what you mean by substantial interest. So this term refers to greater than 20%. So that's what you mean by what you call as substantial interest. So it is 20%. So these are the list of people. So if there is something happening to some benefit is being drawn to them, we said that income is not exempt. It has to be calculated as an income, any free service or value of any free or concessional service. So such income will actually be taxable in maximum marginal rate. So what do you mean by maximum marginal rate? So when you say maximum marginal rate, you take the highest tax rate for the individual. Let's say it's a trust is taxable at 30%. The maximum surcharge possible is 37%, and your cess is 4%. So this put together somewhere around 44-45% will be your maximum marginal rate. So it will be taxable on that particular rate. And the next set of things is any income from investment or deposits in modes other than section 11.5. So if you are actually depositing money in modes other than section 11.5, then also you are not eligible. Similarly, if you are investing in shares other than the shares in public sector company, or other than the shares prescribed under 11 subsection 5 clause 12. So if you are subscribing in modes other than this, then also the any income that you are drawing from this particular concept is not an income which is eligible for exemption. So these are the incomes that are not eligible for exemption. Now when we say that incomes are not income are not considered to be eligible for exemption, such as your private trust for religious purposes, and then we spoke about income from the author, founder, all those closely connected persons, and we also spoke about the income from sources other than what has been defined under section 11.5. So such income, whatever we are talking, is actually not eligible for exemption. Apart from that, there are also some deemed category. That is, what do they say is, when you say deemed, we said transactions with known persons, connected persons, that is right, author, founder, member of HUF, right, all that what we saw. In that, they are giving some deemed connection. So it will be deemed to be for the benefit of specified person if it includes loan lent without adequate security or interest or both. So either you give an unsecured loan or you give probably with no interest or whatever, or both. So that is also probably it shall be deemed to be an income for the benefit of that person. An asset of trust is made available to specified person without adequate rent or compensation. Let's say there is a property, the author is allowed to stay there without collecting rental income. So in that case, it is a benefit given to him. So an asset or trust which is actually given for the specified person. Any remuneration which is paid in excess. How do you know this? It's pretty difficult. So typically something like fair market value. Let's say you are a chartered accountant with 10 years of experience, there will be some market value, right, for the profile that you handle. So that has to be understood and see whether it is within that limit or not. But all these are all debatable and questionable. So basically what the rule says is whatever is paid in excess. Excess of what? Excess of fair market value. What is fair market value? It is about what will generally that person get other than the connection involved here. So that's what we are meaning by. Similarly, services availed without adequate remuneration or compensation. Same concept what we said for the earlier thing of salary will apply here also. In this case, it is for services availed. Similarly, if you are purchasing and selling shares at much lower rate than what it is actually valued at. So that is also covered here. So these income shall be deemed to be applied for the benefit of that specified person whom we were discussing about. Similarly, if you are diverting an income to that specified person, that is also covered. Investment in a concern, we said when we were talking about the specified person in section 13, we said it also includes concerns in which such specified person has substantial interest. So if an investment is made in such concerns, then that is also not eligible. So these are all the section 13 income which are actually not applicable, that is which will not be eligible for exemption purposes. So with that we have understood the entire portion of trust with respect to section 10 subsection 23C and section 11 to 13. Now we said there are few more things, right? So the political trust and electoral trust. The political trust is discussed in 13A and electoral trust is discussed in 13B. But before that we also said there are some special rates, sections which talks about special rates. When we in the earlier session also we were talking about the section called 115 BBC, that is anonymous donation, that is anonymous donation. We said we will discuss about this in detail in subsequent session. So now we will understand about this special rate sections. So one is this anonymous donation, another is exit tax. So we are going to see these two. We will start with anonymous donation. What is the word anonymous? As most of you could probably link it to when you are actually seeing some of the quotes or something in certain websites or certain news articles, sometimes they are used to have this word anonymous. So anonymous is I do not know who the person is. The quote looks good, the whatever proverb or the quote that has been phrased by some person is good, but I don't know who has actually phrased it. So similarly, the donation is very encouraging. I am happy that I have received this donation, but I do not know who has given me this donation, right? So this is that hidden identity of that particular person who has actually donated. So this anonymous donation received by any trust or institution. So now who is to blame? Is it the trust or the person who has provided? Now since I do not know the person who has actually given me this money, income tax says I will tax you. Why should I wait and find out that person, use my investigative skill set, crime skill set, and then identify the person and then charge him? Rather than that, I will charge you. So this anonymous donation received by any trust or institution specified under section 10 subsection 23 clause 23C and section 11, whatever has been specified, that whatever is in excess of that exemption limit mentioned below. So there is a formula that has been provided to calculation of this, and with that they are actually saying that on that particular portion you charge the rate. So what is that limit provided? So they are saying maximum of 1 lakh. Maximum of 1 lakh is what is allowed. So they are asking us to calculate 5% of total donation received. See, let's speak from the language of the income tax department. Income tax says, I perfectly understand it is not under your control. You may not know who is actually depositing you. There might be a hundi or something in front of you where someone comes and deposit money or even throws cover inside your office and leaves the premises, you do not know who that person is. Could be a scenario, right? So now he says, okay, I accept that you are receiving such funds, someone coming and throwing cash cover into your premises, or someone dropping into that hundi that you have. So all this is, I'm okay with this, but I have a limit. I have a limit of 5%. I have a 5% of total donation received. If you have actually received 100 rupees, only up to 5 rupees, I am fine with that. If I don't have track of that 5, I am okay. But I should have track of this 95%. So that's what they say. So if it is 5% of total donation received or rupees 1 lakh, whichever is higher is exempt. So typically the maximum is 1 lakh or 5%, whichever is higher. So if it is more than that, then that limit. So that's what we are talking about. So this amount is what you are calling as anonymous donation, which will be taxed at 30%. So this anonymous donation will be taxed at 30%. So what does not apply here? So the provision shall not apply. Yes, it is about anonymous donation only, but in certain circumstances we are saying let's not follow this, because we understand that there is a huge possibility of anonymous, right? We said there is a hundi, like in temple or something, you go and just drop money into the whatever storage space you have, you just go and drop that money. So whatever you are doing it in the religious institutions, so such money, yes, it could not be tracked. So they are saying if the purpose is wholly religious purposes, then okay, we do not bother about this concept. And in case if it is both religious and charitable purposes, with a specific direction to any university or hospital by such trust or institution. So basically, it is specifically directed to this university or other educational institution or hospital or something. So it is a institute which is purely for religious and charitable purposes. They have received an anonymous donation with the specific directions to be attributable to that university or educational institution or hospital or whatever. In that case also they are saying it is okay. So these are the cases where it is okay to have anonymous donation even above this 5%, even above the 5% of the total consideration. Else 5% of total consideration or 1 lakh, whichever is higher, will be taxed at 30%. So that is 115 BBC. The next special section that we are going to talk about is something like exit tax. We will call this as exit tax, or probably you can call it as, you also have other taxes here. So basically there is some natural addition to the thing which is actually being taxed. We will understand this through the slide so that you get to know better. So this chapter 12 EB is to introduce provisions that will deal with the transfer of assets. So now what they are talking is, there are some transfer of assets from where? From trust or institution that is actually exempt to 11 to a non-charitable organization. So we are talking about a transfer from a charitable organization to a non-charitable organization. So from from an eligible section 11 institution to a non-charitable organization. So what is 115 TD pronouncing? It says a trust registered under 12 AA or AB shall pay tax on accredited income. So they are saying the income from this particular concept of such transaction will be taxable at maximum marginal rate. Okay. So it says what is taxable is this accredited income. So now we immediately need to know what is this accredited income, right? So as we said, the accreditation is basically a natural addition to something. So what they are trying to say is, they are giving us some concepts. So what are they saying is, converted to a non-12 AB. So there is a trust. Now this trust is getting converted itself. The trust itself is getting converted. That is, it's cancelling its trust registration or modifying the clauses in the trust deed. So, or it is merging with an entity which is not eligible under section 12 AB. So it is merged with an entity which is not eligible under section 12 AB. So that is also a possible scenario. So either they are cancelling their own registration, or they are just merging with another entity, or they are dissolving. They are not able to actually follow certain things, so they are dissolving, and there is a failure in transferring all the assets to the eligible trust. So during dissolution, they need to transfer the assets, but the assets that they are transferring is not to the eligible trust. It is probably to what you call trust or organization that are not eligible under section 11 or whatever. So the overall concept is, from a trust eligible institute, there is a transfer to a non-eligible institution, either as a conversion or as a merger or through a dissolution. So this is what they are saying. So now for these transactions, we are calculating this accredited income. So we are trying to calculate this accredited income. So what is this? So it is typically about this fair market value of the assets. So we are going to calculate the fair market value of assets and we are going to reduce the liability. So this net difference is the accredited income, that is basically the value of the trust as a whole. Now when you say fair market value, they are saying exclude agricultural assets, exclude assets which are not classified under the benefit of 11 and 12. So include assets only which is eligible for the benefit, which was eligible for the benefit of section 11 and 12. So such assets minus liabilities. So this is what you are calling as accredited income. So this accredited income was taxable on what rate? Maximum marginal rate. Now once this happens, moment this happens, whatever, so it has to be deposited within 14 days. So there are different days from when this 14 days is calculated. The first one is about what happens when it's cancellation or rejected. So when you say cancellation or rejected, it is, there will be an order, right? There will be an order confirming this cancelling or rejection. So such order date, that appeal confirming, if you have gone on appeal and you are finally getting it cancelled or rejected, that date is considered. And or if an appeal has not been filed, then the date in which the appeal actually expires. So that's what is considered as a 14 days. From that date is what the payment, that is maximum marginal rate on accredited income. What is accredited income? It is fair market value on assets, excluding agriculture assets and assets for which benefit under section 11 and 12 was not claimed. So that has to be excluded, minus relevant liabilities. So with that, whatever income is there, MMR on that, that amount has to be paid within 14 days. In case of cancellation or rejection, within the 14 days from the date of appeal order or date in which appeal is actually expiring. In case if there is any modification, that is changeover from one entity to another entity or something, it is the end of the previous year, that is 14 days from the end of the previous year. In case of merger, the date of merger, 14 days from the date of merger. In case of dissolution, it is period of 12 months. So from the date of dissolution, decision of dissolution, you take 12 months. From that 14 days is what is there. So these are the days. Now no credit shall be provided on that such tax. So whatever is paid is the tax. So that has to be completely taken care. So there is no credit concept for this tax that we are talking about. So that's what we said, it's something like exit tax. Since you are moving away from the benefit of trust, you have already enjoyed various benefits. So we are taxing you for the exit, So no deduction under any other provisions of this act shall also be allowed. And then in case if there is a delay in payment and in 115 TE, there shall be an interest charge at 1% for every month or part thereof from that particular due date. So that is what is there. So till the date of payment, 1% will be charged. And then you have, in case if assessee is still not paying, he shall be called as an assessee in default under section 115 TF. So he shall be treated as assessee in default. So with that, the special rate regime gets over. So we discussed about 115 BBC and this exit tax of this 115 TE to TF. Now, the last two things that we said, we will discuss about the other type of trust, that is political trust and electoral trust. So we will start with the political parties. So they are covered under section 13A. So what are the income that are actually not included in the total income? It is income from house property, income from capital gain, income from other sources and the voluntary contributions. These income will not be considered as an income, will be an exempt income for such political party. So what is not included there? So basically your business or profession is not included here, and of course there is no way that you will have salary. So the only head which is excluded here is profit and gains from business or profession. So PGBP is taxable, right? So that's what is the actual meaning from this particular slide. So what are the conditions to claim the benefit? The first one is accounts has to be maintained. There is mandatorily books of accounts has to be maintained. Mandatorily books of accounts have to be audited, and whatever voluntary contributions are made, there must be a complete track record of what? Whoever has paid in excess of 20,000, other than who is purchasing this electoral bonds. So there are these electoral bonds which are issued by Electoral Trust. So such bonds can be purchased. Other than that, if there is a deposit contribution more than 20,000, it is mandatory that name and address are maintained, and no donation exceeding 20,000 shall be received by a other than account payee mode, that is only through banking mode. Eligible banking mode only is allowed for any donations exceeding 2,000. And the return of income must mandatorily be filed under section 139 subsection 4b. So it is mandatory to file a return on time under section 139 subsection 4b. So these are the conditions to claim the benefit, that is accounts, audit, voluntary contributions, register maintenance, and then your return of income. So these are the concepts. What about electoral trust? So we were talking about this political party. So what about this electoral trust? As far as the electoral trust is concerned, the benefit is very simple. Whatever income you have receiving, it has to distribute 95% to the political party itself. So this whatever contributions is received from the electoral trust, they will have to distribute 95% to the registered political party and functions in accordance whatever the rules that have been made by the central government. So now what for is that 5%? That 5% is for managing its affairs. So it's local affairs. It will have its own team or whatever. So the electoral trust to manage its affair will have this 5%. So however, the aggregate limit, though we say it is 5%, for the first year the maximum is 5 lakhs. For the second year onwards, it is 3 lakhs. So for the first year 5 lakhs, for the subsequent year it is 3 years. So when you say 5%, the 5% is restricted to this amount. The rest all should be distributed to the political party. Only then it is eligible. And they should not use whatever we have seen earlier in this section 13.3 or the members, relatives, contributor, that is the connected persons. So none of the contribution from this particular electoral trust should be used for the benefit of these specified persons. So what do you mean by what are the contributions that are accepted, not accepted, and what are the general conditions that has to be followed? So what is accepted contribution? First is, only thing, it must be received from an individual who is a citizen of India. From others it is not allowed. Or it must be from a domestic company or a person who is a resident, who is a firm, HOP, AOP or BOI. So this is the condition from whom they can accept contribution. So that is what is there. What is not accepted? Since we said citizen of India, of course foreign citizen or entity, foreign citizen or any entity in a foreign location is not allowed. You cannot accept contribution from another electoral trust. You cannot receive it from a government company or any foreign source. You may be an individual citizen, resident of India, but you cannot say, I am using my foreign source and paying this fund to donation to electoral trust. So that is not allowed. So whatever you are saying must be from the source in India. So this is what is not accepted, right? So what is not accepted is these 4 things, that is your foreign citizen entity, another electoral trust, government company and the foreign source. The last one is your general condition, that is what else has to be followed. Basically, we said any contributions that are being collected should only be through account pay, check or draft, and the contributor's PAN must mandatorily be collected. Books of account must be maintained, audited, and if there is any change in the structure of this electoral trust, it must be intimated within 30 days. So that's one of the conditions. So these are the general conditions of electoral trust. Once all this is satisfied, the contribution received, that provided 95% is distributed to other registered political party and 5% is used for what? Used for management of the affairs, subject to 5 lakhs in the first year and 3 lakhs in the subsequent year. So if within that limit, then whatever contribution is received is exempt for this electoral trust. So with this we have covered all the provisions of the trust. So we have covered the trust, political trust, electoral trust and funds and institutions. So thank you for the wonderful session.